And it also means that we kind of want to distinguish between like the value of the dollar, which has continued to go up for the better part of the last 2 decades as a result of stronger growth, stronger productivity growth, the strong performance of its companies, the leadership in technology, and its role in terms of an international currency.
Hello to the latest episode of Future of Money, where we have an extra special guest, a former colleague of mine, now a free agent who's zooming in from sunny Miami. And from one great brain to another, Ebrahim, is that a suitable intro for you?
You've been very kind. Great to see you.
Ebrahim actually has a Greek connection, which I'm sure a lot of people in Greece and policy circles will really not want to be reminded of, or in European circles. Some of you will not know this. For sure, you've heard of the term Brexit. You probably, I mean, if you're listening to this podcast and you haven't heard the term Brexit, I'll be very, very surprised. A few of you will have also heard the term Grexit. If you were around in Europe a decade ago, it would have been impossible. A dozen years ago, it would have been impossible to be turning on the TV, reading a newspaper, reading a blog and not hearing the term Grexit, because in the early 2010s, if there's one term that dominated macro and policy and even the future of Europe, it was this term Grexit. And believe it or not, the founder, the guy who came up with the term Grexit is our guest today. Ebrahim Rahbari. Ebrahim, how? Like, were you in the shower or the bath? Archimedes famously was in a bathtub and had this eureka moment and then ran down the streets of Syracuse naked. Where were you when you had your Grexit moment? Were you in a shower?
Well, the term certainly brings back some memories, and we were going to be talking about debt and inflation. And back in the 2010s, as you said, the eurozone had its big sovereign debt and banking crisis, and the epicenter at the time was in fact Greece. It had these very high levels of debt, fast rising, and there were real questions about what it could do, whether it could sustain and service that debt. And the one thing it couldn't do was to inflate away the debt, because Greece, then as now, is part of the eurozone. So there were some really fundamental questions being asked about whether Greece was in fact able to stay as part of the eurozone, or whether it would have to exit the eurozone. So back then, working as a young analyst at Citi with the then chief economist Willem Bouter, and with yourself as well, we were writing lots of reports about the possibility of a Greek exit from the eurozone or short Brexit. So really, at the time, it was a term of convenience. It took a number of years to work it out. So between 2010 and 2015, really. So the term broadened to other countries which shared similar problems, but fortunately never happened. And so the term fortunately went out of fashion, unlike Brexit, which of course came to pass when British voters voted to exit the European Union at the time. But that's how the phrase came into being.
But the term Grexit, I mean, obviously everyone knows Brexit, but I think people are beginning to forget, but it was epic. It was literally in financial and policy discussions that it was. I mean, Grexit was everywhere as a term. And you made it up. Like how? I mean, you're being very humble here, but how did you make it up? Like, is it just as prosaic as Greek exit, and you got bored of writing Greek exit in your reports or the reports you co with the chief economist at the time? Like, how did you like going back to that Eureka bathtub moment? This was an amazing, like, not many people that I have met can claim to have coined a word as significant as Grexit. And with no Grexit word, would we have had a Brexit? I don't know, the word. I mean, how did you come up with
I,
this?
I should say it was pretty prosaic. So there were lots of reports to be written, and any way to shorten what you're writing and what people are reading, I think was very welcome. But it certainly was, I think, walking into an open door at the time where people were open for new expressions. Again, there was a long list of countries that had issues, long list of situations where an exit from some situation, I think, was relevant. But it did gain a fair amount of circulation. I think the Financial Times made it one of the words of the year. It got me into the culture section of the Wall Street Journal at some point as the beginning of a new line of words. But as we said, I'm very happy that some of the worst case scenarios for Europe and for Greece didn't materialize, and so the
Yeah.
linguistic heritage can live on without the real world consequences being nearly quite as threatening as some thought they might be at the time.
Now, the fundamental question that Greece and policymakers and investors are wrestling with at the time was what's what do you do with debt when you have so much public sector debt, and what's the right level of debt for a country? And I think I'd love to hear your thoughts on, is there a right level of sovereign debt, and what drives that? If you're the US, what's the right level of debt? Or a Japan? You have your own currency, you're a relatively large economy with lots of domestic buyers of your debt, versus if you're a Greece or a Croatia or another country where you don't really have your own currency. It's a shared currency, or you're a country like, I don't know, a Pakistan or an Egypt, where you have your own currency, but it ain't a very strong currency. How do we think about the right level of sovereign debt? What are the factors that go into that?
Yeah, so I think the way we tend to think about debt most of the time is not so much what's the optimal level of debt, or in a way, almost like the optimal capital structure of a country. But I think the question that uh, most people pose is there maybe a threshold level of debt above which it becomes a problem and makes the country very vulnerable? And there were some eminent economists, Carmen Reinhardt, Ken Rogoff, that wrote a famous book about it that said above 90% of GDP is when growth on average really takes a hit and the risk of crisis goes up a lot. And that might be lower for emerging market countries, maybe 60% of GDP for those. So the 90% was for advanced economies. And then many people came back and said, well, really that evidence isn't all that strong. There are lots of factors that go into how much debt a country can sustain. And I think that's very true. I mean, if you look around the world, one of the countries that has the highest levels of gross debt is actually Singapore, around 170% of GDP. But the reasons why it does so is because it raised a lot of debt to invest in a lot of very productive things. So if you look at its net debt, so debt minus assets, if you like, that's zero or negative. Japan, you mentioned, is another example. More than 200% of GDP, 200% of GDP in debt, but a lot of it is domestically held. So what the government is borrowing really is the mirror image of what the private sector is saving. So a bit of a concern, but not really that much of an issue so far. So many aspects determine whether there is a threshold level of debt above which it becomes a problem. But that being said, I do think numbers and reference points and benchmarks are useful. And the one that I like to look at is really maybe debt service and net debt service, which takes into account not just the level of debt, but also the level of interest rates. And because interest rates were low, even as debt was going up, for many years, those levels of debt service were still pretty moderate and manageable. But now they've started to creep up. And for example, if you take the US, obviously the most important country and economy in the world, we've now got to net debt service levels of about 3% of GDP. And that's about in line with its historic maximum. So we are back near the peak, even though interest rates are nowhere near the peak. And that's, of course, again, because debt levels have gone up. Now, historically, there are many, many countries that have sustained more than 3% of GDP in net debt service. Again, for the US, it's high. But I like the reference point of maybe 5% of GDP in net debt service. Again, by no means the peak if you look at the cross section of countries, but it's relatively rare. And if you look at countries that have debt issues, they often had issues when debt was, over 5% of GDP for a sustained period of time. So when it wasn't just the peak. So I will take a good look at these levels of debt service across countries. By the way, the UK is at about 4%. A lot of countries in Europe are somewhere between 0 and 1. So there's a good amount of variation. But these numbers are getting into levels where they're starting to look a bit more problematic. And maybe the final point I'd make is just to say a lot of these debt issues, they come to the fore when the economy is stumbling anyway. So, the Grexit issues came to the fore and the European issues on the heels of the global financial crisis. So a lot of these become a lot more problematic when growth actually starts to weaken. Despite the pandemic recession, as I call it, we haven't really had to face these issues for quite some time. So I suspect the next time growth stumbles, we're going to see a lot more concern about levels of debt and debt service than we have today.
I want to hand over to Gaurav and bring him into the conversation to grill you a bit more about the role of the dollar. And we sort of touched upon it already by talking about how much debt the US has. But Gaurav, over to you.
Thanks so much, Ronit. Ibrahim, thanks so much for joining us as well. It's such an interesting conversation, around this. And on the face of it, it seems so obvious, the US dollar, the US currency being the strongest or the most noteworthy. But, in the danger of seeming obvious, I still don't think it is given today's landscape. And something I'm sure Ronit's going to touch on further with digital aspects of currencies. But while we're focusing on the dollar, can you unpack that for us? Why is it the most, hegemonic in sort of currency in the world today? What drives its strength? Can you unpack it for us a little bit more?
Yeah, so I think in many ways it's relatively simple. I think the role of the dollar really does reflect the role of the US, the broader role, its broader leadership in the economy, but also, of course, in global politics. So that's usually been the rule. The world's dominant currency reflects the global leadership. So the US took over from the UK slowly, but certainly as it was ascending in the global economy. But the one aspect I would kind of center into, and academics, when they try to study which countries emit the world's reserve currency, they do focus and anchor it into financial factors. So you really need a deep, liquid financial market to be that global currency of choice. And the US has by far the world's largest and deepest market, the 27 trillion or so of global treasuries. I think that's probably the single largest factor, notwithstanding again that the US has a broader leadership role as a standard setter across global politics in the legal sphere, which of course reflects that in terms of governance, it's long been seen as credible and reasonable and reliable. So there's a broad range of factors, but I think the special sauce, if you like, really is the deep and liquid financial market in the US, and in particular, the global safe asset, which still to this day are treasuries.
I think might is right has never been clearer when it comes to a conversation, not just when it comes to military machines, but also to resources and having access to things like this, where we're talking about the liquidity. But the next question everyone's talking about from a contemplative point of view, we talk about, a lot of new technologies, a lot of parallel ecosystems coming up. Will any currency replace it anytime soon? I mean, what are you seeing on your radar? What attributes are required for something to displace that, might of the dollar, or even compete with it in any way?
Yeah, so I think we have to distinguish kind of three scenarios. The first one is the dollar's role likely to rise or somewhat decline from here? And I think it's far more likely to decline than rise. And in fact, we're seeing that in parts. If you think about, there are various dimensions of an international currency, but if you look at the dollar as a global reserve currency, it's about 60%, a little bit below that 60% of total reserves. It was 70% about 20 years ago. So it has been declining at the rate of about half a percentage point for the better part of 20 years. Now it's been going up and down over time. If you think of the role of the dollar as an invoicing currency for international trade, again, it's been gently declining, and it's maybe closer to 50% or so, while it is 80-90% involved in global FX transactions. So the role of the dollar, I think, is both variable across different dimensions, but has been coming down. And I think that decline, gentle decline, I would call it, is really just reflecting that the center of gravity in the global economy is shifting and somewhat diversifying. So it mirrors the rise of other parts of the world. So that's number one, but I think, again, an evolutionary aspect. Second question is the one that you directly asked. Is there really a credible contender for the dollar? And people tend to think of maybe some years back, they thought of the euro. Obviously, more recently, the debate has been more about China or maybe cryptocurrencies and Bitcoin. And there really is no credible contender in sight. And the two aspects that I would point to is one very fundamental and obvious, which is it's that institutional setup. We started this discussion thinking about could the eurozone break up in a limited way about a decade ago. And as long as you have these very fundamental questions about these institutions, I think it's far-fetched to think of a global international currency of choice. With China, you have different questions. It's not so much whether China will continue to exist, but in what form and what its relationship will be with the rest of the world would stand in the way of the renminbi becoming a global currency of choice. We have extensive currency controls. Renminbi isn't convertible the way that dollar and most advanced economy currencies are. But in the end, I actually come back to a point I already touched on, which is to be the main currency internationally, you need a very deep and liquid market. And that's what we're missing in all of these alternatives. And that obviously applies to some of these cryptocurrencies as well. So the role of the dollar is very entrenched. There's a lot of inertia in the system. There are lots of network effects. So a lot of things have to come together, but there's both an institutional underpinning, but in the end, it comes down to it is a deep and liquid financial market with lots of network effects that you need to provide.
I think that makes a lot of sense. Thanks for putting that out there. But I think Ronit might have a few more pieces to that puzzle we might want to throw into the spotlight there. So Ronit, do you want to pick that up from your side?
Sure. So we know some of the advantages of the positives in terms of the role of the dollar. And Ebrahim, you talked about the deep and liquid financial market, and that's definitely been reinforced in the last 15 years. So a lot of people will highlight the official sector numbers. 70% was probably a peak. If you went back 40, 50 years ago, it's actually lower, right, Ebrahim? And so the role of dollar, the share of the dollar has come down in recent years. But then the share of the dollar or US dollar denominated assets, say in the equity markets, has gone up. The Eurozone 20 years ago, the UK 20 years ago, China 7, 8, 9 years ago, were all much bigger and more relevant competitors. We're probably at peak US equity market or relative share of the equity market or the corporate sector. I don't know. But there doesn't seem to be any challenges. But one sort of area of criticism that people are skeptical about the dollar or fiat currencies in general throw out is the amount of dollars out there, the money supply. Are they onto something there, or are they just missing an economic point? The point that's often thrown out by skeptics of the dollar or skeptics of fiat currency is there's the sheer increase in money supply during COVID, into COVID, in the last half a dozen years, but particularly around COVID. Ebrahim, give the audience some numbers to put this into context. What's the right metric to be looking at in terms of the number of dollars are there? Which bit of money supply should we be looking at? And does it matter that it's so big now compared to 10 years ago?
Yeah, so actually, let me just quickly touch on a point that you started out with. I should have mentioned, which was the third scenario in the previous question, because I do think when we contemplate whether another currency could take over from the dollar, I think the one thing we have to keep in mind is, could there be a crisis in the US that creates an opening for somebody else to come in? And I don't think it's all that obvious that will come about in the very foreseeable future, but it's not quite as inconceivable as it may have seemed not so many years ago. And I think these are political questions, but they are also economic and financial questions in a world where inflation and the potential debasement of the dollar becomes a greater concern for the population at large, but also for global investors. But where there's also a lot more fragmentation politically and geopolitically. And I like the way that Larry Summers responds to questions like this, because he answer along the lines of the circumstances under which the dollar loses its role of primary international currencies. That's probably one of the least things the US would have to worry about. So those would be pretty tricky circumstances, but by no means inconceivable at this point. And it also means that we kind of want to distinguish between like the value of the dollar, which has continued to go up for the better part of the last 2 decades as a result of stronger growth, stronger productivity growth, the strong performance of its companies, the leadership in technology, and its role in terms of an international currency, which to a large part was really the weakness or the lack of alternatives. The TINA, there's no alternative factor for global currencies is very much at play. And again, whether it's weakness in the Eurozone or the incomplete evolution of China's role in a global context, I think those are at the heart of the US role. So dollar strength and the dollar's role of an international currency, they're related, but by no means the same. So that's a prologue to my answer to your question. So when people think about the advantages of a fixed supply, they seem very obvious, which is on the one hand, the fixed supply is predictable, it's fixed, and secondarily, at least as a store of value, you can have a lot more confidence that it will continue to play that role. When it comes to the drawbacks of a fixed supply, they're a lot more nuanced, and they go back to, well, money has multiple roles. It is that store of value, but it is also a means for transactions, and it's a unit of account. And actually, when you come to those roles, it is a lot more relevant for currencies to actually be somewhat flexible, and that's in a general sense. But specifically, when it comes to the cyclical management of economies, there are times when it's very useful for prices to go up, for there to be inflation, and in particular when global central banks want to stimulate economies, when they want to lower interest rates, when they want to lower what we call real interest rates, so the inflation-adjusted interest rates, when maybe the economy is going through a bit of a slow patch. So that's when you want to encourage some more borrowing, you want to bring interest rates down. It's really difficult to bring down real interest rates when prices are falling. And when there is a fixed supply of money around, then you do have, in principle, this deflationary bias in the economy. As the economy grows and the amount of money is stable, prices on balance have to actually come down. So when we think about the appeal and the merits of fixed supply or low supply of money, I think it's important to look at the importance or the merit of flexible money supply as well. And it served us well over the last couple of decades. I mean, up until the pandemic, inflation was 2% or slightly below, both in the US and in the Eurozone. So these concerns about hard money have been around for a long time, but I think their base has only started to accumulate over the last couple of years. And I think the jury is going to be out whether that's going to be an enduring problem. And I'm not dismissing that at all, but it is possible that it will actually end up fading back into the background as inflation remains moderate and relatively stable.
But zooming in on this issue of just amount of money that the crypto, the Bitcoin maxis, or the gold bugs go on about from either ends of the spectrum. They go on and on about this. Are you not worried about we have just too much money floating around? And is that just an economically not that important thing to, or is it just not that, it's just not that important from a fundamental perspective? Is there like beyond the kind of, without getting into the debate about this whole inflation last 2 years, but like just big picture, long-term fundamentally, is there a right amount of money growth, so to speak?
Well, I do think these things matter, and then that's where the credible, reasonable governance of policy, economic policy, and monetary policy come about. And if you think about the last couple of years, clearly we have had an excess of stimulus. The Fed balance sheet growing to $7 trillion, several trillion dollars of stimulus in response to the pandemic recession. I think there was clearly excess there, and therefore there's justified concern. They've been a big factor in pushing up asset prices into levels which clearly are questionable and bring with themselves the risk of disorderly correction over time. So I certainly think that there are good reasons to worry about the excessive amount of liquidity and money brought into the system in recent years. And I would hold it with Milton Friedman, who argued more or less for a relatively stably and moderately growing money supply. Usually, you think of it broadly in line with nominal GDP growth. So that's roughly, if you assume roughly unchanged, a roughly stable velocity of the circulation of money, that should be your guide point. So the situation, as we did have in response to the pandemic, where the money supply was rising by 20% or so a year, is clearly excessive. Keeping it broadly in line with nominal GDP growth would be, I think, a reasonable yardstick. And beyond that, then you get into territory where rather than stabilizing, policy becomes a source of potential instability. And again, whether that is for price inflation or asset price inflation, it may differ and depend on the circumstances. But I would betray my German heritage if I wasn't concerned about the possibility of excessive money printing and liquidity provision more broadly.
Gaurav, isn't the US just super expensive now? Or do high roads like you still find Vegas and New York cheap? I don't know. Back to money supply and inflation.
I think
What do you
you're
think about
mistaking me for a
inflation?
high roller, which I'm flattered. But honestly speaking, Ronit, I think you're right. And Ibrahim, the cost of everything does seem to be getting more expensive. And we're looking at things like CPIs, or we're looking at consumer price indexes. And we've talked about money coming in, we've talked about liquidity, we've talked about inflation, we've talked about a number of things. Is it linked correctly? Is it reflecting accurately what we're seeing today? What do you think? What's your opinion there on that? I mean, as Ronit said, things are getting more expensive. They are, but is that consumer price index accurate? Is it linked?
Yeah, so let me say three things. I mean, obviously, we've seen a big rise in concern in people complaining about potential doctoring with economic statistics, and CPI is just one example, and that's how I would see it. It's really a symptom. It's an example of a broader distrust in government and in institutions. I for the most part do think that these statistics are accurate in the US and in advanced economies, but clearly there are other countries, Argentina, Turkey, China, where there are enduring questions about the accuracy of economic statistics. So for the time being, in a narrow sense, I think these numbers are accurate. Secondarily, though, I do think that there's a confusion between price levels and inflation. So prices have gone up 20% or so over the last few years, whereas inflation is back down to 2.5% or so in the US and in the Eurozone. And we do tend to remember where prices were and not just where the inflation rate is year by year. So I think that's one source of the confusion. But then there's one deeper consideration, which is simply, are these indices measuring what we care about? And that to an extent can depend on what is it that you are actually consuming yourself. Is that CPI reflecting your consumption basket? But also, CPI doesn't reflect asset prices, which obviously have gone up a lot, and asset prices include the price of housing, and that price enters into CPI in different and obscure ways. In Europe, for example, we don't have owner-occupied rent or house prices, of course, in the statistics at all. So there's a large number of sub-indices that central banks these days are referring to, which exclude any number of things that are, in fact, in the broader basket. So I do think that it's by no means a catch-all measure of everything we care about when it comes to inflation. But again, in a very narrow sense, I think these measures are probably accurate.
And the other thing is we're talking about very mature, developed, ecosystems that are market leaders effectively with very stable ecosystems or very strong points of liquidity or even debt measures we've talked about earlier or touched upon. But what about emerging markets? We haven't really. Can you give us some sort of context or shed some light on emerging markets? We're seeing a lot of movement there on currencies and inflation ratios, where inflation is really hampering and really taking a hammer to currencies. Should they just be using alternatives? We're seeing people, touching on ideas of these digital currencies. We've seen maybe people saying, oh, you should peg to the dollar or perhaps just use the dollar. What are your views or insights with that? Uh, Emerging economies are just a totally different kettle of fish.
Yeah, so I would focus on two points really. One is we've actually had a revolution uh, in monetary policy and maybe economic policy more broadly for emerging markets as a catch-all term, in the sense that a lot of emerging markets have actually been able to do counter-cyclical monetary policy for the first time over the last decade or so, and that was stimulating when those economies were weak and actually tightening when inflation was high more recently. So that's a big improvement, and it reflects the improvement of the institutions in many of these emerging markets. And if you take Latin America as an example, most recently they started tightening monetary policy much earlier than the developed economies did, and as early 2020 or 2021. Inflation actually came down earlier in those economies relative to the advanced economies as well, and as a result, they were able to ease policy before the developed markets did. So I think one important point to keep in mind is many emerging markets are in a position where policy is managed much better now, possibly in part better than in advanced economies. And that ties over to the second part, where I would argue, similar to what we talked about in domestic economies, there's an element of flexibility that monetary policy and money supply brings, and that can be really valuable if you use it wisely. So it comes back to, is governance reasonable? Is it dependable? Is it to some degree rules based with the right amount of discretion applied? And in those cases, I think a flexible currency is very valuable. It can absorb shocks internationally. In other cases, institutions are weak, policy may not be credible, and then you may have to import credibility from somewhere else. And domestically, that may be you link to precious metals, silver, gold, or something else in fixed supply. Internationally, maybe that may be pegging your currency to the currency of somebody else who has more credibility. Who that would be these days would be an open question, of course. Historically, it's been, of course, the dollar mostly, and then in Europe, the euro, and generally often linked to who's your biggest trading partner. That's still relevant for a number of emerging market economies, which again struggle with governance. But the first best clearly is get your house in order institutionally and in terms of policy, and then run policy flexibly based on the shocks you're exposed to, and that would include flexible exchange rates, in my view.
A balancing act for sure, and not an enviable one, I would say, for certain people that are looking to exude stability and also, make sure that they're covered on all fronts to put that back into their economies in emerging markets. But in danger of opening Pandora's box, Ibrahim, I'm going to hand back to Ronit, who I'm sure is going to chase you down on topics regarding his favorite piece of conversation, the future. Ronit, back to you, my friend. I think you wrote a book about this, but I'm not sure. But I'm going to hand it back to you.
Um, there was a book, yes. Are we plugging that book again?
No, let's not. I think it's already on
Well,
number one on Amazon, but I'm not plugging it for you. But let's give Ibrahim his time.
only in the UAE. We need to get it into the US, but that's a story for another day. Last question, Ibrahim. Talking about the future of macro, there's the future of policy in general. I was in Japan recently, and there was a amazing stat that jumped out at me, which is that today or this year there'll be 2 times more people dying than being born in Japan. And the fertility rate in Japan is not the lowest of any of the rich countries. In fact, it's actually kind of middle of the table now. There are many, many lower fertility rates in East Asia. I think Japan's about 1.3. There are many countries, South Korea, Taiwan, Singapore, Hong Kong, maybe even mainland China, that are lower. Well, definitely the city states, Singapore and also South Korea lower. And parts of Europe, Southern Europe, Eastern Europe. What does all this mean when you're thinking about growth, debt, currencies? I know it's probably sort of an Elon Musk level question rather than a professional economist thinking about the next quarter or the next year, but thinking sort of longer term, what does this mean for the future of currencies, debt, growth? Or is the rest of the world going to become more like America? America is in many ways unusual. You talked about your German heritage. Obviously, your name betrays that your family comes from a country that wasn't historically Germany. We're calling it Persia, Iran, I don't know. But most of the world isn't built like America, right? Built on at least this myth of immigration. Is that where we're going, or are we just going to accept much lower levels of growth and all that means for livelihoods and also currencies and debt? And is the level of debt going to be much lower then? That if economies are shrinking, if countries are shrinking, populations shrinking, because that's what's happening in Japan already and will be coming in other countries. There's a headline that I've just read as Gaurav was talking that the Japanese are going to allow in foreign labor into their auto industry, I believe, for the first time. So maybe that's the little bit of a door opening there. But chin rub question to wrap it all up before I let you go back to Miami Sun, Ebrahim.
So yeah, huge questions, and let me say three things. Number one is I do think demographics are hugely important, and again I go back to Germany where I think there is a burden of an aging population that is not just arithmetic, if you like, that fewer people mean fewer growth. Doesn't even just mean that you maybe have less innovation and less productivity growth, but there's the possibility of an innate sense of conservatism of there's less to play for about the future that a shrinking or an aging population can bring with it. And that's uh, even leaving aside the obvious questions about the futures of pension systems, which are by no means resolved for many, many countries around the world, but particularly for those that rely on pay-as-you-go systems. And of course, the politics are very different in aging societies as well, which we've already found out in a number of economies. So I do think demography is not quite destiny, but it matters a lot. My second point, however, is that another topic to delve into for another podcast, perhaps, where there are tremendous advances going on in terms of longevity and what we can do to prolong lifespan, but perhaps also health span. So one of my former PhD advisors, in fact, Professor Andrew Scott of London Business School, is one of the world's foremost experts when it comes to the economic impacts of changes in longevity. But just to throw it out there, I mean, there are many scientists who believe that if you're born today, you can reasonably expect to live at least 100 years, maybe 120 years, and before long, possibly as long as 150 years. So whatever we have in mind currently about demographic projections, it may be completely appended by advances in technology, and how we deal with them is again a completely different question. So then finally, just to think of the economic implications, I mean, the most straightforward is, generally speaking, actually aging and older economies tend to have proportionally more debt, and that's because they grow more slowly, but actually also have more demand for debt. Maybe spending goes up, but actually the desire to invest in relatively safe assets go up. And Japan is a good example. But one aspect that's sometimes maybe a little bit misunderstood is people draw implications for inflation from economic drivers, and there may be productivity growth, and more recently we talk a lot about AI and how AI could be deflationary. And what I like to point out is inflation, in the end, it's certainly affected by economic factors, but it's really a social and political choice. And so it will depend on the country, it will depend on the context, but in the end, it's about what the society as a whole decides which is clearly non-trivial. And again, as economies and societies age, they tend to have a preference for somewhat lower inflation. Uh, that store of value and keeping what you have rises in prominence relative to, again, creating and innovating. But again, it's a choice rather than an implication that's simply grounded in the economics.
And it's a wonderful way to bring back this conversation to what money is. And Gaurav, I think I might have been discussing that in my book, but money is something that we've made up.
It is
nothing inherent. It's money is something that we've made up, but has value because it has use. And it goes back to whether it's the dollar or the real or the rupee or the whatever, the Bitcoin or the Dogecoin or whatever it is. It's if it has use, it has value, and its value and use is determined by us. So if we were a collective community, Ebrahim in Miami, me in Southern Italy, and Gaurav in Dubai, that could be a community we could make up, and we could have a token. Most likely, probably the dollar because, but we could have a token that. And there's some great points there about inflation, like money, is something that we as a society come. It's a social political discussion, and an aging population. Maybe we'll all live longer, but there is a thing about innovation, right, and growth. In younger countries, India is a great example. To some extent, the UAE, where Gaurav and I are normally based, the population is a lot younger than in, say, Italy or Germany, and priorities are different. People are naturally optimistic. They're thinking about the future, whereas there is a sense of kind of fin de siècle, kind of awesome. So thank you again to the coiner of the term Grexit and more. Look forward to seeing a selfie of you at the Parthenon Marbles one day, Ebrahim. We won't tweet out if you're in the region for your personal safety.
Poor guy. Thanks a
Great.
lot, Ebrahim. It's a pleasure having you.
Great to be on.